Welcome to today's Director's Cut. We have Dr. Lynn Helms giving us information on December's Director's production.
Thank you, Bridget. Welcome to October. Just checking to see if you're listening. So it is December. We know what month it is, but we're looking at October production. That's just the reporting lag that we have. So this is a look back about 2 months. October production was pretty strong, but it was down 3.7% from September. That was entirely due to the storm. That storm lasted about a week. The immediate impact of it, lots of ice and snow in North Dakota. During the storm, somewhere between 50 and 90,000 barrels a day shut in, and it took a full month to completely recover from that. So we should see better numbers in November, and with the weather we've been having in December, we should see great numbers. The good news is that we still came in 13% above revenue forecast. So a strong month, with the minimum expectations at 1.1 million a day and anticipated 1.4 or 1.3 by the end of the year. I'm sorry, 1.3 million. Prices have really softened. So today's price around $68.50 for North Dakota crude. That's 2% below revenue forecast. That's down substantially from $80 in October and then $84 in September. So we've seen very significant softening, a lot of concerns about transportation, about world economies with the conflict in the Middle East and in Ukraine not getting any better. Noise on the Korean Peninsula. There's just a lot of national security concerns. Gas production was down 1%, which means the gas oil ratio still rose. It rose about 2%. So we're kind of going to hit that trend now where the tier 2 wells that have been holding that gas oil ratio down, they're going to probably start producing additional gas. Rig count just stuck in the upper 30s, 37 today, 36 for the month of November, 36 in October. Still haven't achieved, except on like a one-day basis, that 40 number that we really think is an important milestone. Wells permitting, pretty steady. The really big thing is the number of wells completed. We're going to have well over 1,000 wells completed this year, and you can see the most recent 3 months, 129, 96, 111. That's duck wells. The duck well inventory should be almost entirely depleted at this point. We met with the operator that had the vast majority of the ducks. I think they had half of all of our duck wells, and they're down to less than 24 wells left in their duck inventory. Those will all be completed over the winter and beyond production by mid-year next year. So when you look at wells waiting on completion, we're down to 350, and that's just pretty much a standard inventory of wells that have been drilled using a multi-well batch process and then waiting for completion crews. 16 completion crews working, so real steady work there. And we saw a record number of wells actively producing, new record, 18,619 wells, and 98 or 88% of those are Bakken and Three Forks wells. You can really see the impact of the October weather in the inactive well count. It went from 1547 in September to 1917 in October. And that was just the wells going offline due to that storm and the delay in getting them back on. The first phase of the Investment Infrastructure and Jobs Act initial grant is complete, 73 wells plugged, and the abandonment of about half of those is complete, 44 wells or 44 sites reclaimed, but that only represents about a third of the sites that we plan to reclaim. We got an extension to the end of 2024 to finish that work. And then by the end of this month, we will be applying for the formula grant funds, which will be another 25 million. And if you've been watching the dockets, you've noticed that any given month, we're confiscating 5 to 10 wells. We're still seeing some of the marginal well operators, the small operators, going bankrupt, going out of business due to the COVID-19 pandemic. Still effects from that playing out. I think it's pretty big news. Only one rig operating on Fort Berthold. That is way, way down. You know, at one point this year we saw as many as 6. So a large percentage of our rigs were operating on Fort Berthold. The story there, and really major production declines on the Fort Berthold production. So 2 years ago, they were producing about 250,000 barrels a day. They're down to under 140,000 a day. And so that's what happens when drilling stops and completions stop. The information to recognize there is that the remaining drilling slots are 95% riverbed minerals. And unless we can work out an agreement between the state and the tribe to develop those minerals and put some of the royalties in escrow, they really run out of drilling room on Fort Berthold, and that's the last remaining slots. So there are, you know, close to 3,900 potential wells that could be drilled. So the number of wells on the reservation could double, but the bulk of the best drilling is riverbed minerals. Just commenting on a few things. Crude oil storage, both private and SPR, still very, very low. So we're vulnerable to any kind of disruption that might have worldwide. Gas capture still stayed very strong, 94% statewide, 95% in the Bakken. Did something a little bit different. What I've done this month is listed the 10 most wanted. And that would be the 10 oil and gas fields that have the lowest gas capture numbers. And so we're going to kind of try to track that. And the reason we're doing that is the legislature appropriated $3 million to encourage companies to get out there and implement some kind of technology or test new technology for gas capture on those type of fields. So we want to help industry identify where the greatest need is, and they can look and see who the operators are there and get an idea who they might be able to work with. But we're staying well above that 91% number, and gas capture is staying very, very strong. On the federal front, I want to talk about a few just to illustrate that this truly is an all of government anti-fossil fuel approach from the Biden administration. So let's talk about a couple of things. First of all, Bureau of Land Management. Bureau of Land Management proposed a revision to their oil and gas leasing regulations. And so North Dakota has responded to that to a request to become a cooperating agency and signed an MOU to work on that. And so that's of grave concern to us. Right after that, the Dakota Prairie Grasslands came out with an announcement that over the next 2.5 years, they're going to develop their travel management plan. That's going to affect every 2-track, every road, every improved road, county road, private roads out in the Dakota Prairie Grasslands. And so state of North Dakota is working on a memorandum of understanding with Dakota Prairie Grasslands to work on that. EPA released its final rule on standards of performance for new, reconstructed, and modified source emissions. It's called the methane rule. And the methane rule could have some pretty drastic impacts for the state of North Dakota. A little bit under 1,400 of our wells in those 10 most wanted fields don't have gas sales. And so 2 years from now, they would be subject to shut-in because they would not be able to continue with routine flaring. And about the same amount of wells, a few less, are our marginal wells, and they would be subject to all the LDAR requirements of a brand new facility. And so economically, that's going to really reduce the number of wells that could be economically produced. So all in all, 2,800 jobs at risk, 57,000 barrels a day at risk. We're contemplating what the state of North Dakota should do in response to that. One other new and really interesting one is the Security and Exchange Commission. You don't often connect that with oil and gas in North Dakota, but on September 27th, they submitted a material change to their regulations. This change would allow the formation of corporations that are called, let me see, I got to find it here. Natural Asset Companies, NACs. In the past, to form a corporation under SEC rules, you had to be able to demonstrate that your business plan would potentially provide a return on investment to investors. NACs are not designed to do that. NACs are designed to take trust fund money or ESG money and purchase land with it and take that land out of production. The only possible return on those investments would be carbon credits or increased value of the land. We're deeply concerned about that. North Dakota is always concerned about land purchases, and so we're preparing comments, and those comments are due by the 2nd of January. But again, you wouldn't expect the SEC to be one of the avenues to attempt to reduce fossil fuel production, but it is under this administration. So it's an all of federal government anti-fossil fuel administration, and North Dakota intends to push back very strongly against that. So a few questions. We did get one question by email. I'll answer that one first. And that was the increase in production. Is it primarily driven by duck wells? I don't know that I would say primarily, but I'd say close to 50% because the current rig count is only able to support probably in the neighborhood of 700 or so completions, well completions a year, and we've seen well over 1,000 already this year. We'll be at a solid 1,100, 1,200. So pretty close to 50% of the production increase is driven by completion of duck wells. The rest is driven by drilling new wells and completing those. And so other questions?
What would be a normal number of duck wells?
Yeah, so the question was, what would we consider a normal number of duck wells? And we think it's right around that 350 number that the drilling rigs are able to outpace frac crews. Frac crews typically can only work during the nicer months, so we're going to see a big slowdown from 16 frac crews probably to under 10 as we go through the winter months, but we've had very mild weather, so they've continued. They batch drill these wells in batches of 5 and 6, and so they're always ahead of the frac crews. We think around 350 is the normal number.
In terms of completions, then, is that keeping up with estimates?
It is. The question was, are completions keeping up with oil production estimates? And we were expecting production growth this year from starting out at about 1 million barrels a day to ending the year at 1.3. And that was going to require over 1,000 completions. And that has certainly come to pass. So it's been very encouraging. Strong oil prices, good market. DAPL has stayed operational. And so people have been completing the wells, and they've brought that duck inventory down to just a couple of handfuls.
2 other questions here.
Okay.
Okay. The first one is, do you consider 2023 a good year for the oil and gas industry? Bad, a mix of both? Also, what's your hope and expectations for 2024?
So 2023 has been a good year for the oil industry. As I said, the prices were good, and they were able to attract enough frac crews to get into the mid to upper teens with frac crews. Haven't been so successful with drilling crews and with workforce there, and there are still workforce issues. 2024 looks to be slower growth, but still people are pretty optimistic. Now, we'll know a lot more. February is the North American Prospect Expo in Houston. And so I always spend the week talking to oil and gas CEOs. And so we'll come back from there with a lot more information. And then May of this year is our Williston Basin Petroleum Conference. And I can tell you that about 2/3 of the booths are sold out. There's still a few of those really nice big booth spots. So if you're thinking about it, we encourage our operators to get on task with that. But a lot of optimism. Booth sales are going well. Registrations are going well. So everything looks optimistic for 24 at this point. Oh, it's for Justin.
The next question that they had.
Okay, very good. Well, if there are no other questions, we'll. Oh, yeah, great. What have I been hearing about ConocoPhillips?
There's all sorts of crazy rumors.
Yeah. So the question is, what have I been hearing about ConocoPhillips? And the wires have gone silent. So the rumor mill is all there is out there. We are arranging an appointment with ConocoPhillips management for February, so we'll know a whole lot more at that point. But yeah, it's gone very, very quiet, which often means that there is something in the works.
Thank you. Ready? Kringstad?
All set on your end there? Okay. Well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. We'll get right into some production updates on slide 2. Brock, if you can just advance those, please. And just I'll move them on here as well. So around the neighborhood here, Eastern Montana has been able to hold steady with their production. Right now, they've got 1 active drilling rig in Eastern Montana, 0 active drilling rigs in South Dakota. A bit of a data lag because of some issues down there, but I'm not expecting any significant changes with our neighbors to the south. On slide 3, this was that snow map and some of the storm issues that Lynn had alluded to. So just visually, what we were looking at, much of the oil field, you can see the cities of Minot there, Sydney, which is on the Montana side, and Bismarck in the south central there. Much of the oil field getting 8+ inches, some areas even higher in that 12 to 18 inches of snow over a 2-day period, and just a whole number of challenges that everyone faced from any type of movements. Again, when we think about the logistics of what has to happen out there, typically these wells have on-site storage. If they're able to continue producing safely, they will, up until the point that they have transportation logistics, tanks fill up, and then things start to go south. And so there's typically these storm events and some immediate impact, but not as severe. And it's typically that day 3, 4, and beyond where those tanks have already filled up. That gas pipelines at the pigging stations are filled up and you can't get trucks in there, or the trucks that are able to move can only move at a slower pace. And so you're just get backlogged on all the logistics out there, and it starts to take a hit on production. And you saw that reflected in the overall numbers. I'll just point out down at the bottom, again, just a slight uptick in GOR, certainly not a record level. But back on that upward trend, we've seen some strong upward trends in the last several months in Eastern Montana on their GORs, which is always interesting. They got a little bit of a jump on us in basin-wide development, and so it's always good to see what our neighbors over there are working on. Some shifts in October estimates, that production decrease that we saw, it appears, at least my estimates are suggesting that much of that was at the expense of the rail movements. And so we saw crude oil by pipe volumes continue to be very steady, and then that drop in production on the market share from rail decreasing. When we take a look at what pricing was doing around the region, PAD 1, PAD 5, this has been the message now for an extended period of time. We're continuing to see PAD 5 be an attractive market for those rail barrels out of North Dakota, somewhere in the neighborhood of call it 80 to 100,000 barrels per day is the estimates for that October time period. For much of 2023, it was right around 2 trains a day, 120 to 140,000 barrels was kind of a typical number, that production decrease impacting those October figures. The EIA did update. I know last month when I was here, they were suggesting that 100% of all of North Dakota's movements in that August time period were going to the West Coast, Pad 5. They've since updated that. They are still showing some of those lighter volumes headed towards the East Coast refiners that still have an appetite for that light sweet barrel out of North Dakota. When we look at pricing as of today, the Brent WTI spread over $5, so we're starting to get back to that environment that may potentially start attracting some incremental rail movements. It's not really over that threshold, but it's getting close. The Gulf Coast pricing still at a premium to WTI. I wasn't quite sure how to denote up what's happening up at Clearbrook. It's a plus, and that's a negative $1.99 as of the latest pricing out of Clearbrook, Minnesota. If I put a dash, it just looks like it's WTI and then referencing it. So, but it's a negative $1.99 pricing at Clearbrook. We saw really that price shift earlier this year. We were always routinely seeing premium pricing for those Bakken barrels at Clearbrook. Some of the market issues and production growth and concerns around the Trans Mountain system and when that would go into service. We're seeing, again, that Clearbrook pricing negative at the moment. Those futures curves turn around Q2 of next year when the anticipation is that the Trans Mountain system will start alleviating that congestion up in the Alberta and the BC markets and then return that Clearbrook market to a premium for WTI barrels. So we're likely to have several months of tougher pricing, something that we've gotten comfortable and very strong pricing for the last 12 to 18 months, and now move into an environment at least until Q2 where it looks like we're back at a more significant discount for those North Dakota barrels. Import exports, just steady on the import side, drop on the exports. Again, trying to reconcile what exactly is happening here, typically marketing volumes moving north and south of the border. No change in the overall statewide flaring and the reasons for those flarings. I won't dwell very much on this. It's been fairly steady the last several months as that gas volume trends upward. Continuing to stay encouraged in the conversations I'm having with those midstream companies as far as getting those wells connected, making sure they've got interconnectivity between gas processing facilities to maximize those midstream assets to continue to capture these volumes. Bit of a hiccup. Again, this was all weather related in October for the new number of wells that were selling gas and the new numbers of wells producing gas. So I'm not too concerned with that hiccup. I anticipate that corrects itself very quickly. The EIA has lowered their long-term outlook here for crude oil pricing, now at the sub $80 at the extent of this time next year. That's a pretty significant change from where they were over the last couple of months. So they are seeing a weaker oil price environment here for the U.S. No major changes, no major announcements as of yet on the gas processing. Those are conversations that continue as far as what those systems need to look like and the specific timings surrounding that. On the residue or the interstate pipeline systems, I'll advance all the way to slide 19. Now well over 80% market share on northern border for those volumes coming out of North Dakota and just over in the lower teens for those Canadian market share. Again, when we were watching this, we're very likely over the next 6 months or so, at least by next summer, going to be in a very interesting situation with that gas on gas competition to remain viable, continue to move that gas onto the northern border system. Canadian producers maintain about 10% of the market share on that system. The remainder is held by marketing firms as well as Bakken producers. So as you near or try to exceed that 90%, that's when I expect the competition between Bakken production, the Canadian production to really intensify. And it appears that we're trending that direction relatively quickly. On the BTU side, with those higher volumes of Bakken gas, the BTU numbers now well above 1,100. No discussions or anything. That's just something we continue to track. We anticipate that it may become a talking point or an issue that needs to be addressed at some time in the future. But as of right now, there's nothing in the works. The last thing I'll mention was an event that happened this week down in, if you look at this map, southern Minnesota. There was an unexpected equipment failure earlier this week on that system, causing 280 million cubic feet per day of capacity reduction on the northern border system. So we did have some production hiccups and some volume impacts here for North Dakota. They were able to quickly address that, and as of yesterday, they were back up at full capacity. So pretty minor. But again, anytime these type of events happen, it's always a reminder of how critical these systems are, how important it is to have those robust transportation options. And when we're as tight as we are with takeaway capacity and as tight as we anticipate, any disruptions like this have a really quick, immediate impact here in the state. So with that, I will be glad to answer any questions.
Be part of this whole government response to Dakota Access Pipeline.
Yes, so the question was on the response, the comments from the state of North Dakota surrounding Dakota Access. Yes, I was active. Yep.
Can you give us a taste of what your comments were?
Most of my efforts were surrounding, what North Dakota could expect in regards to transportation disruptions, discounts. We had a lot of good data for what North Dakota's transportation logistics looked like prior to Dakota Access going into service. We had good data for what it looked like afterwards, and then tying all that information back to dollars and cents of what type of consequences there would be to the region, and then working with all the different parties. It was phenomenal how wide-reaching the impacts of that system are to every corner of our state's budgets and the impacts that would have. And so making sure that everyone was on the same page as far as what would potentially happen related to production, related to transportation discounts, and then each of those specific agencies then working those into their analysis. So on average, if you're looking for a dollars and cents perspective, between pre-DAPL, post-DAPL, the number change that we saw on a statewide basis was $2.40. The Dakota Access system coming online reduced that North Dakota discount by $2.40 on average. And so if that'd be the hard number that folks were looking for.
And just so I'm clear, when was the due date, or when are they planning to have an EIS out? Do you know?
Yes, so the target is by mid next year to have that wrapped up.
Do you feel 2023 wait for the oil and gas industry here? What's the hope and expectation for 2024? And are there any projects on the horizon you feel will help with the climbing oil to gas ratio?
Yes, great question. So 2023, again, I would parrot Lynn's comments. I think it was a great year. The particular standing out was the month that we got down to 4% flaring. Continuing to see dedication by all sides, producers, the midstream companies to stay on top of this. Going into 2024, as I alluded to, I think some of our gas takeaway challenges are going to continue to amplify. And so working aggressively on those solutions, whether that's for in-state solutions for consuming and burning more of that gas in-state on projects, or couple that with incremental interstate pipeline capacity expansion. So I think going into 2024, it's going to continue to be full throttle to stay on top of that issue. Yeah, well, thank you very much.